Hey everybody then, let's have a look at the sexy topic then of PPE, plant, property and equipment. And the first thing we're going to look at is, when can I bring it into the accounts? When can I do it? Also known as recognise. What's the recognition criteria? When can I bring it into the accounts? Well, you can only bring it into the accounts if you control it. So you don't have to own it, you only have to control it. Also, you can't bring it into the accounts unless it's probably going to bring you in economic benefit, i.e. money. So it's got to probably bring in money, so that means it's an asset. And also it needs to have a reliable measure, because if it doesn't have a reliable measure, how are you going to know how much to bring it in at? So talking about that, that's what we're going to focus on for this little session. The cost. What am I going to bring this reliable measure, this PPE, in the accounts at? Well, the obvious one is purchase price, what you pay for it, or what it's built for. But if we're building it, or even if we're buying something, you need to only include directly attributable costs. Directly attributable costs. And those directly attributable costs are those costs that are only paid if you are using this asset, and it will be things that will get it to work and get it to where it needs to be. So any costs such as postage and packing, site preparation, whatever cost to get it to work, and whatever costs to get it where it needs to be. So postage and packing is the best one. Now, you'll also have possibly some future costs. And that could be something like, right, okay, we have to pay in the future to dismantle the asset. Okay, now if you have to dismantle the asset, that's obviously in the future, and so we can't bring it in at its future cost. We have to bring it in at its PV, at its present value. Let's have a look then how we calculate present values. So I'll just do a little example with you, I think. So, e.g., we have to pay 1,000 to dismantle, to take down in 3 years' time. And the examiner will give you a discount rate in order to calculate this present value. So it's a 10% discount rate. Nice and easy. All you have to do is take the 1,000 and divide it by 1 point, whatever your discount rate is, so 1.10. Now that will give you the present value for 1 year. I want to do it for 3 years, so I have to divide it by 1.10 3 times. So divide by 1.10, divide by 1.10, divide by 1.10, or divide by 1.10 cubed. And if you get that, it will come to 751. And that is the present value that you're going to use to add on to the cost of your asset. Okay, so what's the double entry for this 751? Well, debit PPE cost 751. Can't credit cash because it's in the future, so I'm going to credit a liability with 751. But I've got myself a problem here because the liability is actually 1,000, isn't it? In 3 years' time. So what I've got to do, I'm going to leave that 751. I'm going to leave that 751 there, leave it as it is. But this 751 here, we're going to have to build up. That's the liability. We're going to have to build it back up over time to 1,000. Okay, and we call this building back up, we call it the unwinding of the discount. Because if you think about it, how did I get to 751? I discounted it down. So I discounted down 1,000. So therefore, to get back to 1,000, I need to unwind the discount. But let me just be clear, that's what you do first. Okay? And then at the end of year 1, we will do this. We will now unwind the discount. Now, that means build the liability up again. So I need to credit the liability. Now, when you unwind discount, you don't debit PPE or anything, you debit interest on your income statement, okay? We discounted down, I seem to recall, at 10%. So guess what? I'm not going to divide by 1.10, I'm going to unwind by multiplying by 1.10. So what you can do, you can say to yourself, right, 751 times by 1.10. If you put that in your calculator, I think it comes to 826. So I want my liability to be 826. So my liability is currently, though, at 751. So I just need to increase it by the difference, okay? And increase it by the difference, that is 75. That will get me to 826. I debit the income statement with 75 as well. Now, another way of working that, how did I get that 75? You could say, right, it's the difference between those two, or you could just take that 751 and times it by the discount rate. Times by 10%, that will give me 75. Okay, so that's what I'd do at the end of year 1. What I'd also do is the same thing at the end of year 2, but it won't be quite the same thing. Yes, I've got to build the liability up still. I've got to unwind the discount. Yes, any unwinding of discount goes to interest on my income statement, but it's not going to be at 75 because if you remember, the liability is now at 826. So that now times by 10% is 82.6, which we'll call 83. Okay, so if I do that now, 826 plus 83, that comes to 909. That's what my liability is now. And then finally, then at the end of year 3, when I have to do the dismantling, if you remember, here I go. At the end of year 3, I know I'm going to debit interest. I know I'm going to credit liability. Can you work out with how much? Well, my liability at the moment is 909. You can see there 909. So 909 times by 10%, the unwinding of the discount is 91. So debit interest 91, credit liability 91. And then hopefully you can see that therefore the liability at the end is 909 plus the 91 equals my magic 1000, and that's what I'm going to pay off: debit liability, credit cash. So that's how it all works. And let's just recap then this present value. How to calculate a present value. Alright, what we do is you take your future value, so the 1000 that had to be paid, you divide it by 1 point, the discount rate, 10% or whatever it might be, and that will give you there your present value. Okay, and that present value, that's what we use to debit PPE and credit liability. Okay, but what I've then got to do is unwind, if I can spell it right, unwind the discount. Okay, and I unwind the discount on the liability, and I do it each year. And to do that, I need to debit interest, credit liability with how much? Well, with the liability times by the discount rates. Okay, have a go at a couple of the examples then that I've given you in the next section, and then we're going to come back the next session with just continuing this a little bit, looking at borrowing costs. Okay, hope it all helps.